What exactly makes a stock valuable even if it doesn't pay dividends? Let's break it down. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question and break it down. Today we're exploring a common question. If a stock doesn't pay dividends, why is it worth anything? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, someone's wondering if it's true that companies don't have to pay dividends to shareholders. They're puzzled about why owning stock in a company like Company A, which never pays dividends, is valuable. They're trying to figure out if they're missing something, as having a vote for the board doesn't seem enough. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that a share is a small ownership piece of a company, with value tied to the company's assets. Companies can either pay dividends or reinvest profits to fuel growth. Reinvesting typically leads to higher long-term growth, even though dividends offer immediate tax benefits. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. In this answer, the person highlights that companies are valued for their future potential to pay dividends, even if they haven't yet. They explain that stock value often depends on collective belief, like gold or Bitcoin, and investors generally aim to profit by selling stocks. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that stocks gain value from expected future dividends or potential company acquisitions. Dividends offer a revenue stream, which is particularly appealing when interest rates are low, and a company's profitability boosts its stock's attractiveness. All right, now that we've seen what the community had to say, here's our take on this question. A stock's value often hinges on its potential for future growth and profits. Take a tech company, for instance. It might boost its stock value by reinvesting profits into new projects, even without paying dividends. Some investors hope for a company acquisition at a premium price, which could lead to profits. Additionally, stocks can increase in value through market demand, much like collectibles. So in this video, we've covered that a stock is essentially a slice of ownership in a company, tied to its future earnings potential. Companies often reinvest profits to boost growth, which can increase future share value. Investors are drawn to stocks for their growth potential and resale value, beyond just dividends. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.